Hello everyone, welcome to a new chapter, a new topic. Boy, are we going to have fun this week. We're going to begin discussing cash and internal controls. Some of the things that we're going to cover include discussing the impact that the various accounting scandals have had on a new passage of legislation called the Sarbanes-Oxley Act. We're going to talk about components, responsibilities, and limitations of having internal controls within companies. We'll talk about what is cash and what are cash equivalents. We'll understand controls over cash receipts and cash disbursements. We will reconcile a bank account. We're going to talk about how employee purchases are accounted for with the use of petty cash. We'll talk about inflows and outflows of cash, and then assess cash holdings by comparing cash to non-cash assets. So we got a lot to cover. Internal controls. Now, as you've seen in previous chapters, the two key components of financial accounting are to make business activities by being able to measure them and to communicate those activities to the external decision makers. For the measurement and the communication process to be beneficial, financial statements have to be accurate. You might be surprised, though, to learn that some companies' published financial statements are extremely inaccurate. In this chapter, we're going to look at how these things happen and what can be done to prevent it. Companies issue incorrect financial statements for two reasons: for errors and fraud. Errors are accidents. They're accidental errors in recording or possibly failing to record transactions or in applying accounting rules. Though these errors may be unintentional, they do create confusion and could affect investor and creditor confidence. They still create wrong financial statements. Fraud's a whole different animal. That occurs when a person intentionally deceives another person for personal gain or to damage that person. Occupational fraud's the use of one's occupation for personal enrichment through deliberate misuse or misapplication of employers' resources. Now, the first source of occupational fraud is misuse of company resources. The second source of occupational fraud involves financial statement manipulation. Here, those in charge of communicating financial accounting information falsify reports. Now, there's something called the fraud triangle. The interesting aspect that continues to amaze me with fraud is there must be all three elements present ever for fraud to occur. These three elements must be present. There must be an opportunity, which means the situation allows the fraud to occur. There must be motivation, or some people call it pressure, where someone feels the need to commit fraud, such as needing money. Then there's the rationalization, or what we can call justification for the deceptive act by the one committing fraud. What can be done to help minimize fraud? At least one of these elements of the fraud triangle has to be eliminated so fraud cannot occur. Now, you may look at this and go, oh, how can someone get to that place of fraud? Well, it's insidious and it can happen ever so slowly, but it happens all the time because all three elements are available. Of the three elements, companies have the greatest ability is to eliminate opportunity. To do this, companies implement formal procedures we call internal controls. These controls represent a company's plan to safeguard or protect companies' assets and to improve the accuracy and reliability of accounting information. We're going to talk in this slide over this lecture. We'll discuss the basic principles and the procedures of companies' internal controls. Specifically, we're going to look at cash controls. The quality of internal controls directly affects the quality of financial accounting. It is imperative that financial controls are in place and operating efficiently and effectively for the accounting communication process to be accurate. Now, in this section coming up, we're going to talk about the Sarbanes-Oxley Act. So, what has happened over the past decade to 2 decades is a sense of wrongdoing in many respects with many companies on so many levels. Managers have entrusted with the resources of both the company's liabilities and its owners, so both the lenders and the stockholders' equity. They have been entrusted to take care of those assets. In this sense, managers of the company are acting as caretakers of the company's assets. However, in the past 20 years, a lot of managers have shirked their responsibilities and have misused and or misreported the company's funds. In a lot of cases, it was the top executives that were misreporting accounting information to cover up companies' poor operating performance. Such fraudulent activity is a crime and it's very costly. There are reports that the average loss of fraudulent financial statement schemes is about $1 million a time. 2 of the largest profile cases of fraud in the United States were the collapses of Enron and WorldCom. Enron used questionable accounting practices to avoid reporting billions in dollars of debt and losses on its financial statements. Truly, if you were to see the movie Smartest Guys in the Room, it is stranger than fiction. It is egregious, the crimes that were committed. WorldCom misclassified certain expenditures to overstate assets and profitability by $11 billion. Now, there have been other types of financial statement fraud, including creating fictitious revenues, improperly valuing assets, hiding liabilities, and mismatching revenue and expenses. If there's a will, there is a way, and it can happen in so many fashions. As a result of all of these accounting scandals, and in response to these scandals and to all the public outrage that was just going nuts, Congress passed the Sarbanes-Oxley Act, which is also known as the Public Company Accounting Reform and Investor Protection Act of 2002, or as I like to call it, SOX. SOX applies to all companies that are required to file financial statements with the Securities Exchange Commission and represents one of the greatest reforms in business practices in the U.S. history. Now, the Act established a variety of guidelines related to the auditor-client relationship and various internal control procedures. there have been a lot of requirements with SOX. Some of them, as you see here, there was an oversight board where the PCAOB, the Public Company Accounting Oversight Board, has the authority to establish standards dealing with auditing, quality control, ethics, independence, and other activities relating to the preparation of audited financial statements. Then we have corporate executive accountability, where execs have to personally certify the company's financial statements and disclosures, and they have to stand behind the companies they represent. Severe financial penalties and potential imprisonment are the results of being fraudulent. Non-audit services, so they've got guidelines such as it's unlawful for the auditors of public companies to perform certain non-audit services such as advising and investments. And then there's work paper integrity retention. So the auditors of public companies have to retain all papers for 7 years or face a prison term. There's auditor rotation, which means the lead auditor in charge of the audit has to rotate off within 5 years to allow a new audit partner to lead. There's conflicts of interest guidelines, where audit firms aren't allowed to audit public companies whose chief executives have worked with the audit firm during the preceding year. There's guidelines in hiring the auditor. There's big things regarding internal controls. So internal controls, the Section 404 of this Act, requires that company management document and assess the effectiveness of all internal control processes that could affect financial reporting, and that company auditors express an opinion on whether management's assessment of the effectiveness of internal controls is stated fairly. Now, smaller companies don't have to provide this. Large companies do. I will tell you, though, even though there are such sweeping changes, the sad part is we see fraud as prevalent as ever. The accounting scandals in the 2000s prompted the SOX Act. Among other stipulations, they set forth a variety of guidelines related to auditor-client relations and internal controls. So that's the big focus for us, is discussing types of internal controls in the accounting processes. Here's a question. Which of the following statements is not true of the Sarbanes-Oxley Act of 2002? Is it A, all companies in the U.S. fall under its provisions? B, it helped establish guidelines for internal control procedures? C, it helped establish corporate executive accountability? Or D, it helped establish guidelines for auditor-client relations? Well, we know B, C, and D are correct, and not all companies are required to fall under its provisions. So that is incorrect there. It only is applicable to companies who are required to file financial statements with the SEC. Let's look at some components and responsibilities along with limitations of internal controls. Now, continual monitoring of internal activities and reporting of deficiencies is important, and it's required. Monitoring includes formal procedures for reporting control deficiencies. Control activities are the policies and procedures that help ensure that management's directives are getting carried out. This would include authorizations, reconciliations, and separation of duties. Risk assessment identifies and analyzes internal and external risk factors that could prevent a company's objectives from getting achieved. And ultimately, the control environment sets the overall ethical tone of the company with respect to internal controls. It includes policies related to management's philosophy. It assigns responsibilities, and the control environment would provide an organizational structure of the hierarchy within a company. So this is really a beneficial guideline or visual of helping you understand how the internal controls are carried out. Here is an example of how internal controls are linked to the information provided in financial statements. So Regal Entertainment Group, this is a piece of its annual report, and it shares here in the notes to the financial statements that a company's internal control over financial reporting includes policies and procedures that pertain to the maintenance of records and accurately and fairly reflect the transactions and dispositions of the assets of the company. And they also provide reasonable assurance that transactions are recorded as necessary to permit prep of financial statements according to GAAP, and that the receipts and expenditures of the company are being made only in accordance with authority of management and the directors. It also goes on to say that they provide reasonable assurance regarding prevention or timely detection of unauthorized acquisition, use, or disposition of the company's assets that would have a material effect on financial statements. So this allows you to see how, as a result of the passage of the Act, things have changed, and companies are now required to report on their internal controls. Now, examples of preventative controls include separation of duties, such as authorizing transaction activities, recording transactions, maintaining control of the related assets should be separated among employees. Physical controls or assets and accounting records need to be kept safe and accessible only to the authorized personnel. Proper authorization, only personnel with authority should be allowed to collect money or to process transactions or make purchases. Employee management is where employees should be trained to carry out their job and must be made aware of any internal control procedures, responsibilities, and be aware of channels for reporting things that are irregular in activity purposes. And then e-commerce controls. Now with so much of our work being done online, only authorized personnel should have passwords to conduct electronic business transactions. Make sure we have firewalls so it prevents unauthorized access, and that there's software that is regularly being updated to protect the integrity of people's information. Now, examples of detective controls include reconciliations, performance reviews, and audits. So these detective controls will help detect, uncover things that maybe have gone wrong. Reconciliations, physical assets must be verified to make sure they match with the accounting records. Performance reviews, employees' actual performance must be measured against their expected performance to see if there's any strange trends going on. And then audits, where outside auditors come in and ask to assess internal control procedures to see if there are any deficiencies or fraudulent behavior of employees. Everyone in a company has an impact on the operation and the effectiveness of internal controls, but the top execs are really the ones who ultimately take the hit, take the responsibility. The CEO and the CFO sign a report each year assessing whether the internal controls are adequate. We saw earlier Section 404 of SOX requires not only that companies document their internal controls, and assess their adequacy, but that the company's auditors provide an opinion on management's assessment. The company, the PCAOB Oversight Board, further requires the auditor to express its own opinion on whether the company's maintained effective internal controls over financial reporting. So things have changed. Unfortunately, it really hasn't changed the outcome of fraud. It has made people more accountable. Let's check your understanding. If a company places cash receipts from the day in a safe or a bank deposit box, would this be an example of, would it be a separation of duties? Would it be a physical control? Would it be reconciliation? Or would it be a performance review? Take a moment to look at that. Tell me what you think. Physical controls. It keeps that money safe. Important items like cash need to be kept in safe places. Let's take a look now at exercise 4-3. We've got some statements about internal controls, and we are to agree or disagree. State whether the answer to each of these statements is true or is false. So let's take a look. The components of internal controls are built on the foundation of the ethical tone set by management. So yes, the goal of internal controls is to create a tone throughout the company of following ethical and right procedures. Do the right thing. Once every 3 months, managers need to review operations to ensure that control procedures work effectively. Is that important? I don't think so. Collusion refers to the act of a single individual circumventing internal control procedures. We will be talking about this down the road, but collusion involves more than one person. Next, detective control procedures are designed to detect errors or fraud that have already occurred, while preventative control procedures are designed to keep errors or fraud from occurring in the first place. We got it there. Yes, that is correct. Fraud committed by top-level employees is difficult to detect because those employees often have the ability to override internal control features. Correct. That is unfortunate, but in fact, they do have more power, more authority. Therefore, they should be definitely trusted more, and isn't always the case. Next, a good example of separation of duties would be having one person collect cash from customers and account for it while having another person order inventory and maintain control over it. Now, is that a good separation of duty? No, it's not, because one person has total control over the cash, one person has total control over the inventory. There's no segregation of duties, so that would not be a good method of internal controls. Next, employees' tips historically have been the most common means of detecting employee fraud. Guys, can you believe it? That is true. Next, detective controls include reconciling the physical assets of the company with the accounting records and comparing actual performance of individuals or processes against their expected performance. Yes, that is correct. And then the last, effective internal controls and ethical employees ensure a company's success. Well, that's helpful when we're dealing with internal controls, but that does not necessarily ensure a company's success. We need a heck of a lot more than just that. So as we move on here, we now are going to look at an excerpt of Regal Entertainment's auditor's report related to the effectiveness of internal controls. Now, the PCAOB requires the auditor to express its own opinion on whether the company's maintained effective internal controls. This slide shows an example of the auditor's report. It says here, in our opinion, management's assessment that Regal Entertainment Group maintained effective internal controls over financial reporting is fairly stated in all material respects based on the criteria blah 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 of COSO. These are required paragraphs that must be relayed specifically. Now, unfortunately, even with the best internal control systems, financial misstatements still occur. While better internal control systems will more likely detect operating and reporting errors, no internal control system can turn a bad employee into a good one. Internal control systems are especially susceptible to collusion. Collusions where two or more people act in coordination to circumvent internal controls. Top-level employees who have the ability to override internal control features also have the opportunity to commit fraud. For example, managers may be required to obtain approval from the chief financial officer for large purchases. However, if the CFO uses the company's funds to purchase a boat for personal use at a lake home, fewer controls are in place to detect misappropriations. Even if lower-level employees suspect wrongdoing, oftentimes they feel too intimidated to confront the issue. Finally, because there are natural risks to running any business, effective internal controls and ethical employees alone cannot ensure a company's success, or for that matter, even their survival. Here, Regal Entertainment shows you they recognize limitations of internal controls and provide a discussion on this issue in its annual report. There are inherent limitations in the effectiveness of any internal control over financial reporting, such as human error and the circumvention or overriding of internal controls. Let's take another question now. This one says, everyone in the company has an impact on the operations and effectiveness of internal control, but who must take final responsibility of internal controls? Top executives are ultimately responsible for the success of internal controls. Let's look at another exercise, exercise 4.4. And basically what we're going to look at here are some various transactions, and for each of the scenarios we're going to determine which control, if any, was violated. And we're going to look at specific activities such as separation of duties, physical controls, proper authorization, employee management, reconciliations, and performance review. So the first one, a manufacturing company compares total sales in the current year to those in the previous year, but does not compare the cost of production. So what is the issue here? Performance reviews. That provides us with a control. So that employees can have easy access to office supplies, a company keeps supplies in unlocked cabinets in multiple locations. What do you think's going on here? Which control is being violated? Physical controls. At the end of each day, a single employee collects all cash received from customers, records the totals, and makes the deposit at the bank. Oh my. What's a problem here? One person's doing it all. There is no separation of duties. At the end of the year only, the company compares its cash records to the bank's records of cash deposited and withdrawn during the year. Those reconciliations should happen minimum of monthly. A company encourages employees to call an anonymous hotline if they believe other employees are circumventing internal control features. Now that's a really good idea. There aren't any controls that are being violated here. Whistleblowing can be a really great tool. Last, all employees have the authority to refund a customer's money. What's the problem there? Shouldn't there be authorization in order to just be able to go and refund money for an employee or for a customer? That seems a little goofy to me.